Hey guys, welcome. Very happy and delighted to have John Lee at CEO and founder, let me rather say CEO and founder of Silver Elephant Mining, with quite a few holdings across interesting places as well. In fact, we're speaking to him currently in Mongolia from our cuddly little spot in Panama. John, glad to have you on the show. Welcome.
Yeah, thank you, Francis, for the invite. It's great to be on your show for the first time.
And give us a little bit of your background for people that don't know you, because you have essentially walked the deserts. If I can give you a little bit of a big up and tee you up a little bit, you've walked the desert of a very frustrating precious metals market for quite a while, but you are actually a founder of a small cap, for now, I argue, silver miner with a variety of holdings, if you care to detail those. Give us the story since how you started it, why you got into it, and your journey so far.
Yeah, Francis, I was born in Taiwan, and I've been in the mining industry, the metals investment business for 20 years. The first 10 years, it was 2000 to 2010 as an investor after I semi-retired from the Silicon Valley. And I was doing quite well in investing in metals and mining, and caught the bottom of the gold market at $250 when Gordon Brown dumped the last batch of gold.
Brown's
The kind of the silver market when the silver was $3.50 back in 2004. And then the financial crisis came in 2010. I started a junior mining company as a hobby, and think of just a hobby, and 13 years later, turning into a 13-year double full-time job, raised over $150 million through the Toronto Ventures Exchange. I'm an avid traveler and economist, a chartered financial analyst, traveled over 40 countries, lived in 3 different continents. So always been very fascinated. My passion is always just be arbitraging the market, like you are, but now I've added this dimension from the mining side as well. Francis.
Only someone with the work ethic of a Taiwanese would take up a hobby of starting a mining company, I have to say. I love that, by the way, and I'm not surprised that sucked you in hands, knees, and elbows in the end. And now you've walked this entire desert. It's become the hobby of a lifetime. But seminal week, I'm going to argue, for the metals markets that we've just had. Starting possibly with the last few days of last week, we actually got kind of hypey, and we were even using the chat AI GBT to do those sort of somewhat baity headlines in our YouTubes to say, this is a key moment that is potentially coming technically, macro technically. And I understand you're a man who isn't shy of the charts. You had a look yourself. I'm interested to hear your views if you see this sudden breakout out of that continuation for gold, which invariably leads before silver, which probably leads before the miners, which is why maybe you haven't yet got the love you deserve and other miners, but that could be coming on the way. What's your take about, is it a big week that we've just had?
Well, Francis, you can look at the analysis from short term, in terms of weeks, or medium term in certain 6 to 12 months, or the long term, which is a decade long sort of a scenario. I think in short, this breakout is long being anticipated. I was on a couple of shows last year, in October, calling about it, the gold for around $1,700 and silver at about $17. And this year, end of last year, I pegged gold to take out 2,000 and silver to take out 30. I think we're very early. So all these objectives looking to be met. Gold already, but silver soon to follow. We talked about the gold to silver ratio. I do believe that this is going to be the year 2023. Right now, I think specifically to answer your question, the dollar. I think there's a lot of fundamental news that are out in the market. People are talking about the BRICS and the China Russia alliance is out in the open, and the dollar index had a double-digit percentage correction from 114 now trading at 101. So it is at that fairly strong trend line of support, and the gold is teetering on breaking out an all-time high. So now if you're a trader, Francis, it would be good to take maybe some chips off the table, because you're at a dollar support and you're at a very heavy gold resistance. But fundamentally speaking, I do expect gold to break out over 2,000 and sort of embarking on a $2,400 minimum, and silver breaking out 30. Taking on $50. Now the question is the market going to sort of revert back to selling May and walk away? and then waiting for a September seasonality rally, or it's gonna just to carry on, steamroll through, past 2000 and onto the unknown. I don't have the crystal ball, but however, if you look at if you look at the yields, which is sort of a direction, telling you direction of the dollar. I mean, the yield is also had a big fallback. My personal view of the yield is embarking on a multi-year bull market, which means the treasury is in a major bear market, because if you look at the yield, it's a 30-year breakout.
Yeah.
Which means that I think the yield right now is only taking a small breather. I don't think the Fed is maybe taking a pause, but you're not looking at any sort of quantitative easing on the horizon. So then what that means is maybe some of that news on the dollar bear, or a lot of that already be factoring into the market. So I would not be surprised to see maybe a bit of consolidation for gold and a bit of a rally in the dollar from here. But it's not a high confidence call, because you never want to sort of bet against a bull market being smart, right? However, we're near that major resistance for gold, and major sort of a good support line for the dollar prices.
Yes, I think that's a good summary. I do feel that we were very early. We were in 2020, the back end of 2020 of August. We were the first and only analysts that we saw that had said the bond market 40-year bull had turned. Now I'm of the view that that's everybody's opinion. However, we will, if we get a bit of a demand-destroying event. We've got labor market data coming out tomorrow. I'm not sure if you're familiar with the economic calendar. I'm sure you are, but you might not have it at the forefront of your mind tomorrow. And there's a lot of whispering, including Goldman Sachs, which often seems to be, the early leak venue for bad numbers, that there could be a big spike in the unemployment claims. So we could see during that, because it looks like the 30-year yield, if I had a look at it, in fact, I'll maybe take you to the charts on the 30-year, because you mentioned rates, which I think is another important thing that the average investor doesn't watch enough, is that this is a debt-based system. Every currency is borrowed into existence. Banks, rates, bonds.
Cost of money.
Yes,
yeah,
100%. And it's such an important, I think
the 10-year right now is at about 350-ish. 10-year and 30 years almost trading
350. That's right. We've got 350. I'll go to share screen mode. I just want to get the correct chart view before I bring that into image. But this is a breakdown for us, very technically clear. Let me just get that up and go share screen. And you mentioned this, and I'm really grateful that you did that, because I was actually showing this on Twitter to followers and first to my community, in fact, that we are having a downside break here. This is a long-term bull market in the rates. So this is the 30-year yields. And I think they will have to go up again, but we're going to go into our first crisis of, here, this looks like a very key break, technically, of a very grinding structure that we've had along here. You had the proper slap in the face after reaching for the 4.4s on the 30. That came back really hard. And then there's been a squeeze here, and now you're leaning on this level, and it looks like you're giving up. So it looks like the first fear mode is coming. The big question you're going to get out of a lot of the metals allies, silver and gold stackers, is, are we going to get big price pullbacks now if we go into a fear mode and the stock market sells off? We go into, let's say, a mini or maybe even a major COVID type event. Let me not use that word, March 22 type equity pullback. Do you think the metals get affected by that? Or will it be like that event of March 2020 where they get a temporary spiky effect down and it almost comes back super quick, whilst oil itself was smashing to zero and metals continue on their bull run? So is there a possibility we get a similar type price behavior, or could they even go just direct to continuing to make their moves up, even in a very contractual environment, on the basis that people will even further abandon their dollars for precious metals? What's your scenario for if this 30-year continues to bleed down?
Yeah, you know what, Francis, on that chart, if you can click on all and see just how the yield has behaved since 1980. I think now that would be, I don't know if you can see, if you can.
Yes, I will bring you more data in. This is the secular reversal you're referring to.
Absolutely.
Yeah.
You can see that the yield actually broke out in early 2009, about 2019. And it was just somewhat put back, the genie was somewhat put back in the bottle. And now you have a vertical breakout on the yield since 1980. It's very clear and plain to see. So from this chart, for instance, I don't see a lot of downside on the 30-year. And then if you were to gauge the market and watch the CNBC and the typical bond manager, I think there's still a lot of the people that are that are behind the market. I think we're in a circular bear market for Treasury, and this chart speaks for that. So there may be a bit of and then I mean it's quite unprecedented when you see 30. This is 30-year. You went from sub 2% now to trading it. We're at clip 4%. It's already doubled within a year and a half. So it's quite natural to see a bit of consolidation for yields, but you can also see very strong support at the 3% range. I think the problem is the slowest we fall, which means the downside of the yields or the upside of the Treasury is really quite limited. And then fundamentally also for that thesis, you've got over 2 trillion of Treasury sitting in China, Saudi Arabia, Japan, and all those people. I think they could get out of the Treasury if they could in a hurry without much collateral damage. They'd be quite happy to do that.
So would
market yields. Now, translating to the equity market, if you look at equity, I think the bottom is in. You can paint a lot of bearish pictures from employment, from CPI. Whereas I don't read a lot into those data points like you mentioned, because, I mean, for instance, recalling the days when, I mean, these numbers are a lot of this all made up. Like, I was just a bit of a sort of smothered when the same pundits were claiming that the CPI was heavily managed. They're not accurate. As soon as CPI goes the way that they want to see, then they're almost, bracing us as a Bible. So all those data points only to support the guys that are pulling the levers, for instance. And the guys that are pulling the levers, their long-term, 3 to 5 year horizon objective is to bring the rates substantially higher. So they have to manufacture or have to put up the right data points to support what they're doing. However, as I mentioned to you, that the rates already double. So I would not be surprised to see a bit of, provide a bit of relief before the next rally in the rates that's coming to fruition. On the equity side,
I'm not to rally during that spell whilst we have a little bit of rate pause,
pullback,
or even pullback. And then rates to return. But surely when they return again, that's going to be bearish generally, particularly with the tech dominance NASDAQs.
Yes and no. For instance, if you look at the NASDAQ, well, I think a good example I will share with you, because I was very bearish at S&P and NASDAQ. I said, well, you know what? If the yield is 2% and P is 20, then if yield goes to 4%, then PE's got to go to 10, right? It just yields. But if you look at the real estate market, especially in Asia, they're not falling, even though the yield has more than doubled. And so I think from that token, I'm not particularly bearish at the equity market because they're quasi-tangible assets. They're still assets. And then if you look at the charts technically, they're both S&P, Dow, and NASDAQ, NX 100. They're all well above 50-day and 200-day moving average. So if you're a trader, you gotta follow the trends, and the trends are that the equity market broke out of their consolidation correction range that started from the COVID, and they're on the way to go up. And then if you look at also in the 1970s and 80s, during a period of stagnation of inflation and little growth, equity never crashed. So the way I look at it is we're going to be enduring a consolidation range. You're going to have sector rotations amongst staples, amongst traditional industries, amongst tech, and this money is going to be rotating back and forth. You're not going to see a breakdown, I don't think, nor you're going to see any sort of breakup or upside. That's my view.
Yeah. Funny enough, I find the general equities, the least interesting place, the indices. But I am a bit uncertain because I feel personally that if we have a demand-destroying event brought on us, a bang failure, and we could go into panic selling, I think that remains a possibility. But I also within that recognize that there is a inflationary environment, and where do people put their money? And debt isn't it anymore. For me, the whole wall has been dropped on debt. And to a lot of people, particularly in the States, it's an equity culture. But when you look at valuations, I do feel that eventually the US markets have to stagnate. And if you look at demographics, a lot of it is held locally, and a lot of people are now withdrawing from the system as pensioners. Peak pensioner was passed last year, December, of the boomer generation. So it's going to become a retirement village to a degree, the States, and that's not new investment nearly as much as old. So I'm a little bit less bullish the equities than you, but I don't think it's the most interesting place. I mean, precious metals have got to be it. For us, surely. When will the miners turn? And let's have a look at silver, because one of the things you mentioned is that we're both passionate about silver. We've got a strong handle above 25 now. So this is a chart I'm pretty sure you'll know well. And do tell the guys where are your holdings. It's quite interesting. You were saying you passed through Panama on the way to Bolivia. I think that's one of your strongest holdings, Latin America.
Yes. Well, I think first, let's go back to the equity market. I traveled over 40 countries. I lived, in Europe for several years, in Asia and in North America. A couple of points I want to bring up and highlight is S&P 500. Over 50% of S&P 500 revenues are coming out of are derived internationally, not domestically in the U.S.
Yes. So there's a dollar hedge in that.
Right. So the second point here is that if you look at some of the hyperinflating countries, like if you look at the times when Argentina was imploding, or Brazil, or even Russia, their equity market is actually outperforming, is actually breaking out. So in an era of inflation, equity market tend to actually not, like I said, it's not an interesting market, but it's definitely not you definitely want to be cautious if you're subscribed too much about Peter Schiff or the Robert Kiyosaki side, which I am not in that camp. That if you want to short, you got to really pick your spot very, very carefully, because you can get enrolled into your sort of self reflecting point of view. That's not what the market is telling you. So
on a big time frame, that's a hammer there. Then a spinning top, and we got a little bit of two reasonably strong green months here after a big head and shoulder correction. So when you've just made a head and shoulders target, you tend to get a rally. That doesn't mean it's the end of the bearishness. You're certainly looking like you've got on a pretty big time frame. I'll just go back to show the head and shoulders that was there. You've certainly performed to that head and shoulders, and you've rallied well, significantly back up after that sell.
You know what? That looks like a reverse shoulder and hold. That looks like a reverse head and shoulder with a neckline that's about to break out to me. This is what
you're saying. So let me just draw that.
Yes.
On the other neckline, do we have a left and a head, and are we making another inverted? We come up to the same neckline for 105. That was the bearish structure over there. And could this be a pivoting level actually? And it's an interesting observation.
And to that, for instance, if you look at international markets such as South Korea, Taiwan, or even Shanghai and Hong Kong, they are a bit more bottom. They're just coming out of the bottom, so they're not rallying as strongly as S&P has. So that's telling me that there's a lot of pent-up demand in Asia that had not been maybe fully reflected on the S&P, and that's providing support and fuel for the S&P. I mean, a lot of countries in Asia are coming out of the COVID restriction, and you're seeing very robust consuming market in Asia. So that's something not to take into account.
Yes. I've just brought up the Kospi for interest because we have a view on the Korean won, and it's been very interesting markets. But this had a downside setup that we saw perform. It sold off and it actually overperformed to its target. And since then, it's also doing a very similar potential reversal structure. Again, pivoting in and around a level there. So you're getting a bit of a double bottom with left and right shoulder, W.
It's quite close to me.
And a right shoulder. And it also looks reasonably bullish. So yeah, I'm not an indice shorter right now. And I would argue there's even a couple of longs to be had in this environment, which points to that rate potential pivots, that pivot on rate opinion journeying, certainly for the US. Kospi looks good to me, and you were also mentioning other Asians, and it has
Francis,
quite.
let me share with you a secret. Then we can go into silver. If you look at it, if you stay in Kospi right now, just pretend that you can erase the Kospi on the top left corner, and pretend this is your. Let's just think of a. Let's pick a market of which you're most bullish on. Okay, say gold. So if you'd imagine this is not a Kospi chart, but instead this is a gold chart, we will be hopping all over. Oh my God, this is reverse head and shoulder. This is gonna be imminent breakout. So I think a lot of times we're gonna call the charts exactly as it is, right, and not have any predisposition on.
100%. Yes,
turning to the corner. Yeah,
that's very scientific. You've got to remove. I like looking at charts before I know the name, because then you don't have any bias. I'm not an inherent perma bear on indices. I think that's a journey to the poorhouse, if ever you want one. And I actually see
silver.
Yeah, let's go to silver, because that's where we're going to have our metals friends are going to be really happy to have someone with real experience in managing a silver mine, and their views. So this one already has quite a lot of draws on it, and we're seeing this very impulsive move. We've got this capping descending line here, which seems to encapsulate the pause period, because it was quite a lengthy pause. It was a bit of for many new metals buyers, they were really bummed out by that. So, especially if you're from the crypto markets where, when moon type category, they've been really walking a desert over here. We had an inverted head and shoulder again. We seem to be talking about those a lot. Made the target there, then pulled back to the neckline, and now we're spitting up. So I kind of feel the running of a 25.7, which doesn't look a long way off. We had 25.1s going on twos, will be a technical break that we've already had on gold. So let me just jump between the gold and silver just to highlight that. I'll take the eye off there and just do it on the overlay draw, because I've got a lot of work on there. It's kind of a messy chart. But we've had that triggering event on gold already, with gold being the leader. And it does feel like silver is now coming for its own. Being the higher beta version, it had a deeper dip. What's your take? Fire away. The John Lee take.
Yeah, for instance, if you look at the silver, when I called the bottom, I came on a couple other shows in back October of last year. You can Google me on YouTube. And it was quite clear that, well, first of all, gold and silver market are heavily managed. That's why you see all this volatilities on the upside. And the managers, let's call them the managers, will actually deliberately fuel the market, even on the upside, to try to establish a top to exhaust the buying for the metal. And from there, they're going to start picking away by shorting the futures and the ETFs. Now, October 2022 was the bottom for gold and silver, and that was coinciding with the top of the dollar. And the dollar was stretched, I think, about 114. That's as high as we could. I wasn't seeing much more upside on the dollar. And that's why I was calling the bottom for gold. But subsequently, if you look at the short term, the next, I would say 4 to 6 weeks, they're hitting the resistance level, right? Gold is hitting the all-time high resistance. And typically when you have a, historic sort of a highest level, it's going to take some time, or maybe a couple more tries to overcome. And the silver is laggard to gold, and it's hitting at that $25 congestion level. It has not hit over 30 yet. And I think right now it's maybe a type of caution. I would not be surprised to see a bit of a pullback and a bit of a rally for the dollar. And the dollar is at about 101. So it's at the bottom of that trading band between 100 to 110. So I would not be surprised to see a little bit of the rally on the dollar and subsequently put a pullback on gold and silver. But that is a low confidence call, Francis, because we are in a very fundamentally strong metals market. However, then on the other side, if you look at the factoring into the seasonality, there's the proverbial selling May and walk away. So I think I'm sort of a mixed.
But that's a traditional equities measure. I'm not sure miners have always followed that. They've followed the industry more, surely. The sell in May and go away is a disinterest. It's Northern Hemisphere taking summer, basically, because of they were all off during August, and they start to wind back down. What do you make of the gold-silver ratio? We've got our own technical view, but I don't want to contaminate your opinion. What do you think on this? Surely this was a blow
Gold to silver
at the
ratio
seminal event.
Yeah, I mean, gold to silver ratio is at about 80 right now. It went as high as 100. And at 100, it is a very, I think there's only 2 or 3 times in history that ratio is hit that high. So usually on a high gold to silver ratio tells me that there is more fear than greed in the market. And I do expect silver to outperform by the time it's all said and done. However, the ratio is telling me right now there's not a lot of speculative interest from, when I say speculator, or generalist funds or retail. There's not a lot of speculation in the market right now, in the metals market. And when that happens, when you see a lot of sort of froth in the market, and then you're going to see a lot lower gold and silver ratio down to 50 or 60. So the market is telling right now that gold is still trading at a premium to silver, and there's a reason for that. Besides, besides there's a lot of fear in the market, not so much greed.
Well, it's the central bank, surely. Central bank buying, it will be gold. The predominant movement.
But there's also a factor on silver that's placed sort of pressure on silver. If you look at copper, right? I mean, the world is going through the world is going through slacks. Like, there is not a lot of demand out there in construction, in infrastructure. China is cooling down rapidly, and there's not just whole construction activities. There's just not a lot of infrastructure, and people say copper is the doctor for gauging the health of the world economy, and copper is copper is sort of doing so. So I think in terms of analyzing for silver, it's got still 70% industrial demand, and I think the speculative investment demand is kind of slowly going to tilt over the balance. But for now, the industrial demand is putting that lid and pressuring silver market. And that's why gold right now is performing better than silver. And as you mentioned about the central banks, that's another different factor. I mean, silver investors are very different from gold investor, and gold is a central bank play. And right now, though, Francis, there's stories about 60% of the gold purchases, anonymous sources speculated by central banks. My take on that is, Francis, actually, my thoughts are this actually more people are front running the central banks. People know the imminent central bank diversification, and the politicians and the maybe the well-connected Warren Buffett's networks. So the guys are stealthy, accumulating gold before the inevitable happen. With the central
and is that going hand in hand with a dumping of treasuries, particularly U.S. debt?
Yeah. Well, when you see the headlines of Russia buying gold or Brazil buying gold, that's going to be, by then gold is already broken out. So right now we're still teetering on that stealthy phase, and we haven't seen anything resemble a top for gold. My call on gold this year is minimum 2,400. Earlier I said gold at 2,000 back only 5 months ago. Nobody believed me. So we're very close in timing, calling the bottom for gold. But this year, I think gold is going to easily take out 2,000 and make an all-time high and establish a new high. I don't know whether it's 2,400 or 3,000. Nobody knows. As I said, for instance, the cartel is going to fuel the fire until the exhaust of the buying. We don't know what that happens. Everybody's going to wake up with their fingers crossed, hoping for the exhaust of the purchasing interest. And the way you can tell that, for instance, would be the volume of the COMEX and the ML and the LBMA and the LME. So once you see the volume start taping out, concurring with the top of the market, that's when you know that the gold and silver tops are in. But we do expect a very major bull run coming this year. I'm very, very bullish, Francis, of gold and silver this year.
Excellent. Yeah, it sounds indeed that way. Tell us a little bit about your own company and valuation. I think you said something quite extraordinary. Ounces in the ground. How did you verify that? How much does your business have? And what is the valuation per ounce in the ground that you're currently being afforded on your own holding? Because that's, apart from an opportunity, I suppose, to promote your investment, silver elephant mines. It's also the GDXJ, where people, the junior miners, where you're not really getting much fizz out of this not particularly sexy chart at this juncture yet. But if some of the things that you mentioned come to fruition and you start to get 45s on silver and 2,500s, we actually see the doorstep of $3,000. We see 2.9 in 18 months, and maybe sooner. What leverage you get with the more marginal players, and use your own company as an example. How many ounces do you have in the ground? Start with that.
Well, yeah, Elephant's project in Bolivia, the name is Pulacayo. It's over $50 million investment, over 100,000 meters of drilling in the ground. 100,000 meters, 100,000, it's 100 kilometers of drilling. So you can imagine how much stuff is being drilled in the ground with over 100 million ounces of silver that's being verified independently.
How do you verify that? Is that geostatistics, samples, etc.? In other words, it's not... It's likely. It's a probability-based assessment, or is it
for instance,
quite factual?
Yeah, I mean, you drill within so like to establish a measure indicated resource. Typically, you would drill with a 25-meter density, which means that if you have a volume, let's just imagine for the sake of an example, it's an open pit style. It's a very consistent mineralization. Then you're looking at a block of volume. It could be about 50, in silver elephant's case, could be 50 million tons, okay? Yeah. So 50 million ton of dimensional block of rocks in the ground, and then you multiply by the average grade per ton of silver and gold. In silver elephant's case, would be about 100 grams. Then you will count, and 100 grams, 3 ounces. So if you multiply 3 ounces by the tonnage, then you come up with the resource estimate.
Okay, and
another analogy would be
100 million.
Another 100 million. Yep.
That you had estimate in there, ounces.
120 million ounces altogether. Of that, 100 million ounces the high confidence level, and then the 20 million ounces in the less confidence level. And then when you establish the confidence level, is based on the drill density. Because the closer the spacing of the drill holes, then the more confident you are in the metals in the ground.
Gotcha. So if I just took 110, let's say I half the 20, and I multiplied it by a $45 price, but then of course the cost. What is your average cost for extraction at the moment? Because we've seen First Majestic at the moment. They've got a project that's absolutely killing them. And has got, it's well above the price of gold and silver to Jared Canyon. That's right. To retain. So it's non-profitable. It's sucking out cash. It's taking the profits generated from other sites. What's cost of extraction for you at the moment? Have you mined and brought above ground? First of all, you have got that far. You are that stage mine?
No, we're not. We're pre-production stage. So you're looking at a piece of land.
Yeah. And what do you estimate?
Yeah. What do you estimate? I've been around for over 25 years. I met Keith Newmeyer before he started First Majestic. So I've been around for a while. It's more art than science. I mean, even the shrewdest people, smartest people like Keith clearly had miscalculated the cost and the sort of economics of Jared Canyon. So it's more than art than science. And nobody you can take a piece of paper called feasibility study. You can quote the numbers, but given this inflationary environment and cost factors all over the place with extended delays, I would not actually venture to guess what our sort of the project economics will be in terms of the capex and opex, in terms of like how much money to get the mine out of the ground and to start an operation, and how much per ounce is your cost, so what is your margin per ounce. But I would say this, I don't think any miners right now, if you look at the charts of mining companies, which you talked about, Francis, that I don't think anybody's making money on a $25 silver. They're ready to bring a lot of capital expenses to make sure that the mine can continue to operate and not to bleed cash. Just goes to show that the gold and silver right now, despite gold is near breaking an all-time high, but they're not catching up with the cost of operation. So a couple other things, as you touch on, which I want to bring very quickly. The way you value gold and silver companies, there's two ways to value them. One is cash flow, okay? and then you take a PE on that, and you do a sort of a back of the envelope NPV and IRR based on the reserves and based on your price projection. You come up with cash flow, and you take a PE on that. For gold and silver, maybe 20 to 40, and for base metals, maybe PE will be slightly lower. But that's only part of it. The other side of you measuring gold and silver companies is the optionality aspect. So optionality is kind of like the option trader, right? So let's say Dell Computer is trading at $40, and you're actually paying a premium to buy a Dell options to buy sometime in the future at 45. You have to pay to buy a call option at $45. That's above what Dell Computer is trading. So the way you look at the junior market, pre-production stage company like Silver Elephant, of which right now the market cap is 20 million. It's got 100 million ounces of silver, just call it that. We're paying 20 cents an ounce of silver in the ground. So it's akin to you're paying what, $1 or $2 on a call option for Dell Computer at $40 trading right now. So what makes it intriguing, interesting, and speculative is that it's not so much the cash flow or a PE ratio of mining company, but it's how you calculate the call option on these ounces in the ground, what you anticipate the gold silver prices to be in the future, and then how much. I mean, you can buy a higher quality silver asset with fewer ounces in the ground. That just means that your strike price is closer to the call prices right now, or you can buy it slightly out of the money, higher resources, but maybe cost a little bit more to extract. And so that is more art than science. For instance, if you trade options, the volatility and you calculate the Black-Scholes model, and it's all over the place, right? It's all over the place, which is what we're doing right now. And if you look at the junior mining ratio, but if you look at gold and XAU ratio, if you track the gold versus junior miner or XAU or HUI, they're at very, very low level. They're at the bottom in almost, or maybe already broken down their consolidation range. So, I mean, that tells you two things, right? Either the junior mining company is telling you that the imminent bear market is on the horizon for gold and silver, which I don't believe to be the case. Or the other case would be that maybe gold and silver only embarking on they're yet to break out. The market don't believe they're breaking out, and that the market sometimes they're wrong, and that if they break out, then there's a lot of catch up to do in the junior mining and in the mining sector. For instance, where I see things that have been around for 25 years, this is a very, very similar. And I dare to say,
to uranium, almost 10 years.
Like in 20 years ago, it's not even 10 years ago, it's 20 years ago. Back in 2002, when Gordon Brown dumped that last batch of gold from back in England at $250 an ounce, and it was very clear. It's clear the bottom is in, the equity market is top, the dollar is top, and the hegemony is broken down. Bill Clinton was the president. It was as good as it could get in the fiat system. And nobody loved gold and silver. It's very, very similar. I see that deja vu from my lenses. And what's happened right now is because you have the carnage from the cryptocurrencies, you have the carnage from the fallout of the equity market, you have COVID, and you also have this demographics of the shift. The baby boomers are retiring. They see gold and silver as mining companies, speculative assets, so they want anything to do with that. But it's very akin to 2002, 2003, when the bull market started. They just lost so much money in the mining space. So there's a lot of babies are needing milk, but just not so much milk that's available. So that's why you see pockets of mining companies that have sort of getting good volume, but majority of that, First Logistics is a good example. They're still in that consolidation range, are a lot closer to the bottom. They're 20% of the bottom, about 70% on the top, for instance. However, I don't want to preface also saying that I think once gold breaks out of 2,000 right now, it's near all-time high, but if it does break out of 2,100, then the market will recognize that they were wrong about the mining equity, and then they're going to catch up very, very quickly. And the interesting thing is, all the mining companies in the world is half from Microsoft. So you're going to see a lot of buying siphoned through a very small, thin straw. And you're going to see some very spectacular performance on the mining sector, just like it was in 2004, 2005, when silver staged a rally from, I remember, $4.50 to $15 in a hurry, like in less than 18 months. You can see something very similar in replay. It's very low-winded answer, Francis.
Yeah, no, but it does. I can see it in a sense that even while the metals are getting their recognition, miners in many cases have forward sold future production at lower levels. The market is fatigued with equities in the mining space more than they are with the metal, even though they can see the fiat system failure. And they're happy to hold gold. They're not yet ready to deal with these companies that have burnt their hands so many times, that have seen these hyperinflationary costs climb up in the form of the industrial metals like copper and other things, energy that mines consume really aggressively. And in actual fact, it seems almost like your project should remain, I don't want to say mothballed, it's not mothballed, but non-production, until such time as you start to have some real price discovery on the underlying metal in the ground, and then you can.
And so, for instance, what we're doing now is it's a bit of a cliche, but de-risk the project. So what I mean by that is we will maintain an excellent local community relationship. We are advancing in near completion of all of our permitting process to make sure the project is what I call the shovel ready. And then when we capture the silver market, which is 20% from the top, right now we're 20% from the bottom, but when silver price is 20% from the top, I would say that we're not venturing into any sort of production discussion until at least $30 silver. Because I think to put a mine into production with this price volatility, with all the uncertainties of construction delays and all that mobility, labor, work stoppage, health mandates, it'll be suicidal to do that. And unfortunately, for us, is exactly what happened in the last 18 months. You're seeing a number of juniors that had gone into that didn't survive onto the other side because they were busy commissioning golden and their project. And you got a couple of downswings in the silver price down to $16. They registered a couple of quarter of losses, and then they're breached their covenants. Their debtors come calling, and that's the end of the story. Unfortunately. There's several of those that went on.
Yeah. And you have to avoid that false start. And being such a volatile underlying, even to gold, which has got some volatility, it's even more dangerous. You need to get deeper into the black zone in price to allow for much higher percentage leverage pullbacks in these demand destroying events and these ups and downs. But at the same time, if you get it right, surely that should be the lottery ticket for your great-great-grandkids, even, never mind enough wealth to see you to a comfortable retirement.
Well, Francis, if you that's sort of stepping into the options realm, right? For junior miners or for mining companies, if you have 100 million ounce discovery, such as the discovery that Silver Elephant has, typically in a mine plan design, I sort of need to know more than I want to know. In the last 13 years of running a company, the mine design is usually running for a 10-year mine life. So the optimal design for a mine with 100 million ounces of silver resource would be 10 million ounces of silver production per year. So for a minute, imagine that the mine actually goes into production at an annual production rate of 10 million ounces a year. And I just said a break-even price of $30 to account for inflation. So if silver does go to $50 at a $3,000 gold, and that would in that case the gold to silver ratio would be about 60, which is quite reasonable.
Yeah.
And you look at
200 million a year
dollar margin of $200 million in cash flow at a $50 silver price. At a $200 million cash flow for a silver company would have a PE ratio of about 30 on average. You're looking at a company of $6 billion market cap.
And as high as 30? Would you say as high as 30, given the volatility of the price?
Sometimes go to 50, Francis.
Really?
The ratio, the typical PE ratio for a gold and silver mining company is at around 30. For copper, it's about lower at around 10 to 20.
Why is it such a high PE ratio? I thought I'm learning here, so forgive me for lack of knowledge. Then, But I've always considered, that if the S&P was at an average of 30, it's overpriced at PE. Why would metals be different and higher in valuation? Because it's got a 10-year life and it's over. I mean, it's not like Microsoft, which is going to keep selling Word and Excel and I'm even using a tech example because they have a short life cycle. It's not Coca-Cola, for example, that has a brand and will be selling bottles every year. How does that come about that you get such good gearing?
Yeah, well, PE ratio, remember, that's based on the E today, not on the E tomorrow. Now, for E to go up for a high-tech company like Tesla, because people are thinking that it's going to sell more cars, so it's going to bring their future revenue, the future PE will be so the present PE owes a lagger to the future. For gold mining companies, people are always thinking, you're not going to mine more gold per se, but the gold price is going to go up. So the future cash flow, the future earnings, I thought, could be a lot more than the present earnings. And that's why
even with a 10-year cutoff point. I mean, because Tesla will have new models. They're not dying in 10 years. I mean, the mine will be exhausted in 10 years. It has a much shorter lease on life. I just find that part I found aggressive. Nothing else in your calculation seemed aggressive. 200 million cash flow. I could see silver through 50 in 3-4 years significantly. The only question is the inflationary aspects as well. Will it be allowed to accelerate away from that and to continue suggesting the higher E? I think it can too. It could get to 100 and the whole concept of a dollar is going to change. I mean, $100.
Exactly. You're measuring dollar. Dollar that exists 10 years.
Well, what will you buy with a dollar? You won't buy anything with a single dollar, and $10 won't pay for, someone to clean your windscreen. So who knows?
Real quick, Francis, the market is saying that Tesla's PE should be 2,000 and Coca-Cola's PE should be 15. And the market, based on my research and based on the last 20 years, is saying that the PE for gold companies should be 30 and for copper companies should be 15 and for coal companies, like black coal, should be 5, right? And then they could be right and they could be wrong. The one thing is, Francis, the mining sector is one of the most asymmetrical sector. And so there's always, the information is always very asymmetrical. And that's why the timing, you have to be very good on timing in the commodity business. And the other point is about, talk about a $2 billion market cap. When I first got into the silver business in 2002, 2003, I knew a person by the name of Ri Fan. He's a very good friend of mine. And he discovered a mine in China, and they started out with a $40, $50 million market cap. I put a private placement in their company at 75 cents. And then the silver price then went from $4 to $17 in 2007. And their company went from 30 million to 2 billion. And their annual production is at around 10 million ounces, including byproducts. So this is not some hearsay or some fairy tale. Yeah. This is, if you look at First Majestic as well, right? That's another good example. I remember First Majestic when IPO, I think it was around 2004, 2005, when their stock is at around $3 $3 a share. That's before they even went on the New York or NYSE exchange. They were just trading on the Toronto Stock Exchange. But you are also right that there is that depletion factor in the modeling, in that the mine would deplete eventually. It's a burning match. And that's why that's another reason I said that the industry is very asymmetrical. Even the industry experts can get it wrong, such as Keith with the Jerry Canyon. And the sort of the answer to address the reserve depletion is you got to look at the quality of the asset. Maybe there's a lot of potential to expand the asset resource. And you also got to look at a management that's very shrewd in looking at quality assets to acquire at the bottom of the cycle and not at the top. So there's a lot of, it's a very, I often say, for instance, coming from the .com industry in the early 90s when I semi-retired, if you can be successful in mining, you can, it can be successful in a lot of other things. Because it's not easy. It's not easy.
The great irony now is never before have I personally felt that a small cap silver mine could be better positioned than right now. I think you're about to come in to all-time lows, and without understanding the minutiae of the day-to-day mining management and the fundamentals, for timing and recognizing that in timing, because you had the same thing in uranium and yellow cake and the ex-Soviet Union's overhang having to be burnt off, and it was a dead industry. And now the total sum of uranium miners were less than a single, market cap for Exxon Oil, which is also an energy company. Only, those uranium could power, I don't know how many more burn more flames and keep more homes warm. So you get these huge macro distortions. They're so hated, so ignored. And I think with the metals just starting, this has got to be one of the best times to be positioned. And your 15-year wait may finally be coming to fruition.
And more than a couple of things. And that's why I said this is a deja vu of 2002, 2003. Because I think the pre-acts in 1998, people lost their shirt. The bulls in 1980, they were still writing, and they were just like, oh my God, I'm only 3 years away from kicking the bucket, right? They're exhausted. And this is exactly what it's almost a deja vu. This is exactly what I see. People that got into gold and silver in 2002, they're back to where they started. Their mining shares are lower than when they started in 2002, except in several instances. They're just like, I'm done with this. And a lot of them kick the bucket, unfortunately. And then the new generations are still in crypto. They're not even got into the mining space yet. And now it's a buyer's market. Right? This is absolutely the buyer's market. However, the junior market is not for faint-hearted. There's a lot of obstacles to put a mine into production, and that itself is very difficult. So right now, I want to recommend.
That's increased. Can I jump in? Sorry. That's increased with all this ESG stuff, hasn't it? Immensely.
Oh, my God.
And haven't they just added another layer of cost and extended the cycle to actually get something in? So that's a big spoiler, that people will be going through things that even veterans haven't gone through before in terms of having to go through this process.
You're absolutely right. So let me finish my thought. I'll get into the ESG. Francis, to get a mine for the mines that we operate in Mongolia and Canada and United States, it's taken them 10 years to get to where we are. From the previous operator to the ones we inherit over, and now just to put a mine into production from the day of discovery is going to take you more than 10 years. It was taking you 10 years. It's going to take you 15 to 20 years, and it's just the bureaucracies and everything. And that's why I advocate for people that get into the junior mining space for the first time is put more eggs in the basket. So I would never sort of, pounding my chest to say, put all the money in Silver Elephant. And so you got to put more eggs in your basket, different jurisdiction, different sort of stage of the project. But I will recommend, because right now it's such a buyer's market, you can go after assets already had a proven discovery. So, right, for instance, you don't need to be speculating on whether they have silver in the ground. There's already stories out there with silvers in the ground, and you just got to make sure that management execute the business strategy to make sure that they can come through with the permit and then either buy out or ability to raise money in the market to put the money into production. I think that's the first thing. I want to talk about ESG. Unfortunately, you got this ESG layer on top of us. Either you believe in environmental, social, and governance, or climate change. It is coming. Okay, it is here. For a company, even without production, we now, in order to get audited and to be certified, to be signed off as a public listed company, we have to produce an ESG report. And so you're absolutely right. There's an extra layer. And even in the auditing industry, in sort of being a public listed company, the government is tightening the industry. So there's government auditor, the auditor itself, which means that there's fewer partners that can be assigned to a mining to audit. So I think overall, for instance, what I see is a very clear trend of cost of doing business going up, amongst other things, which is only going to exacerbate inflation as it's coming downstream.
And I was going to just add that whilst that's a downside, it increases the lag time to bring new production online. So this price, when it does run, could run a lot further because you've got all these built-in obstacles for the price, normally fixed supply issues. But when you add further buffers of obstacles to be covered, and all these additional bottlenecks, it means you need a much larger price, and you almost need a complete bottleneck emergency where the ESG guys are eventually told, if you don't wave this through, forget about your battery car, forget about your battery thing. You need to start dropping these obstacles. You need to start giving some permits, and you get to this backlash, ESG. And we've already had a little bit of that against wind farms, how ineffective they are, killing birds, burning up in flames, etc. So it's kind of almost that we'll need to have this reality check. And in the meantime, price just really rockets, so that by the time you do get going, it's just cream and honey.
Francis, it's first of all, this barriers to entry, and so the ESG is going to create barriers to entry. Once the train leaves the station, another train is not going to come to carry passengers, right? So the investment opportunity is also so limited. It's not just ESG. There is First Nations consultation. A lot of the local people that are become a lot aware of environmental aspects of commissioning a mine. So there's a lot of complexity, and it's going to be a lot more challenging going forward. Even in the United States, I don't think there's been a mine that's been commissioned in the United States in the last year under the Biden administration. So from permitting, from ESG, from First Nations consultation, is going to take a lot more time. Now, a couple of interesting aspects I want to share with you. Mining is almost like a vicious cycle or virtuous cycle. So when the prices go up, even existing mining companies will be reluctant to increase production. They want to throttle, they want to squeeze their production because they don't need to. They don't need to put in more production because they get a higher price. They can deliver they can deliver their earnings through higher prices. And consequently, prices, when the price is in a downward spiral, the mining company will actually fuel to the fire on the downside because their margin is shrinking, have to mine more. So it's a vicious cycle. So you not only have this barrier to entry, but the mining company itself is, it's not going to, you don't have to worry about their expanding production to make more money because their money is already being made through the higher share price. And you're also right about this is what I call right now is demand destruction coupled with supply disruption. And because, all the logistics of, and the mandates and the blockage and the health mandates, all that is causing disruption, but we have a demand destruction at the same time. So we're going to go through still a period of this price volatilities, but I do see that the demand destruction, I do see that the supply disruption is also going to be eventually causing supply literally stoppage. So eventually I think the supply side is going to be, it's going to go down faster than the demand destruction. It's a classic economics 101. So right now we're still seeing this balance right now. You're going to see it outright. You're going to see runaway inflation, but not maybe in a year or two. But then usually gold and silver, they're front running the market, right? So this is a foretelling sign that you're going to have, quite serious inflation that's taking place. But and right now it's curtailed by the demand destruction. But eventually the supply is going to dwindle. You're not going to see people like throw $4 or $5 billion build a new mine. That's going to take used to take 2 years, not going to take 5 years. It's just not going to happen, Francis.
Yeah. And you're not going to find banks. You're certainly not going to find banks in retreating banks lending that. It has
the banks used to go like 2%. Now it's LIBOR plus 6. Yeah. Your cost has gone up in all. And that's another thing, Francis. People say, you're going to raise interest rates to stifle inflation. In fact, interest rates is higher interest is going to fuel inflation because your cost of doing business go up. And to service debts, like a lot of the Dow 30 and S&P 500 laden with debt, they're going to have to adjust the price upwards to service their debts. So raising interest rate doesn't necessarily is going to cause you lower interest rate. A lot of interesting dynamics at play, Francis.
So I've got two big fundamental questions I'd like to run past you. Let's start with the one on a more macro basis. Supply of above ground silver. This seems to be the thing that nobody really wants you to know the number. I would like to know your best guess, because you, as a thinking smart man, you've got to have kicked those tires before. And people, and then overall view of projection of the increase of its just silver's role in things like solar panelization, Tesla cars, how much do they actually use? Surely it's more than a ICE car, etc., etc. So demand projection versus what's currently, if nobody's supplying, what is the number approximately that can be called on? Global above ground production.
Yeah, I mean, let's talk about silver. I did a lot of study on above ground silver inventory, and I've read studies from Ted Butler. Nobody knows. Two things. I think first, people that, for instance, it's my belief, well, gold and silver is money. Okay, the real people know. So it's my belief that gold and silver prices are suppressed and through various means, and the people that are the back end, people are the trucks show up at the refineries. My belief is 60-70% of gold is, well, not so much on silver because it's industrial, but it's about gold, and to some extent silver. People are buying on a truckload. There's no intention to exchange for fiat. Like we talk about the future of the dollar. So even if we know a number of, say, silver and gold, I don't think there may not be actually a price
to
point.
flow. So some of it's going to be held.
They're not going to come out in the market, right? Yeah. So I think that's the first thing we got to establish. I think there are some generational players out there, and they own probably in excess of 50% of all the gold in the world, and their wealth is not measured in dollars. They control the printing press. They're in fact, for instance, instructing the J.P. Morgans and Goldman Sachs to short the market, printing papers,
so that they can buy more.
To back them on the refineries to accumulate. So I think just because there's X amount of silver above ground doesn't mean that it's going to come to the market. They're not speculating.
So let's talk about available potentially to be purchased for fiat to be used in manufacturing.
You talk about scrape silver and etc. I'll give you sort of an interesting point. Is silver went up from $15 an ounce to $49 an ounce. I think it was back in 2012, 2013.
Yeah.
And it was reportedly Eric Rod and a couple of Asian investors that were conjure up about, a few $100 million and went to the market and want to buy 50 million ounces of silver. 50 million, francis. And that triggered a run on silver. And that is a story that I heard. And eventually J.P. Morgan were caught naked and have to somewhat, I think they spewed about 100, 200 million ounces to calm the market down. So that is the story that I heard. I think that, look, for instance, if somebody were to come up and want to make a go at it for 100, 200 million ounces of silver, which is about $4 billion, I think that in itself would drive easily silver to break out of $30. I don't think that there's 100, 200 million ounces of silver available in the market. And then if you look at prices, how fragile the system is. As you know, like futures market right now, COMEX silver trading at probably 50,000 ounce contracts a day. That's 250 million ounces per day that's changing hands. There is a week of volume. That's more than the nominal silver trading on the futures market for a week. That's more than the silver production, which is about 1 billion ounces. 1 billion ounces of silver physical is only $20 billion. We're not talking a lot of physicals out there. But no. In my view, I don't believe that there's 100. I don't believe there's 200 million ounces, and even 100 million ounces of silver to be had. If somebody would just come with the money today and say, "I want that silver," unfortunately, Francis, it's not that simple. If a guy really want to come up with $4 billion, I want to buy 200 million ounces of silver would be $4 billion. If some guy read a check for $5 billion cash, which is not insurmountable or inconceivable. Instead of getting silver physical showing at the door, they're going to get a call from the FBI. President.
Yeah. I agree with that. Hey,
I don't think Warren Buffett is wise.
They'll get the Hunt Brothers treatment. They will almost be viewed as the Hunt Brothers and saying, you're destabilizing the system, you're a terrorist. Wanting to buy that amount of system, you're going to be labeled a terrorist.
Warren Buffett, I don't think Warren Buffett, if you look at what Warren Buffett said about silver, Warren Buffett dislodged their silver, I think it's about 150 or 100 million. I don't remember how much in early 2000s. And Warren Buffett bought silver Warren Buffett's a smart guy. He never said he bought silver because of inflation. He bought silver because of whatever, right? It was mispriced. So Warren Buffett actually never mentioned about inflation. He also have a thin view on gold and silver, saying that, you cannot eat it, well, you cannot eat US dollar either. So I'm just saying that the people that know the market it's not so easy to sort of accumulate, but they are in that stealthy accumulation phase. Because if you look at the spread of silver physicals versus silver price right now, the margin is as high as it's ever. Like to buy the American Eagle right now, it's going to cost you about $35, if not more, on a $25 silver price right now. Usually, high margin spells for the froth or the peak of the market, but not in this instance. And so, for instance, I can clearly see that the cartels are managing the silver market and throttling of the retail demand by throttling the physical to the coin with the mint. So that's why and that's going to be continued the case. They're not going to ban people from owning gold and silver. They're just not going to give the gold physical to the mint to mint their coins and bullions. Unfortunately, that's why I said a lot of that gold and silver is going back into the cartels. That's not going to see the light of day. And so therefore, I don't think the amount of physical above ground inventories is a material discussion, but nonetheless,
it's a good.
I don't think there's 200 million. I don't think there's 200 million ounces of silver to be had. If somebody want to go at it,
okay,
it's not available.
And the game is essentially for big buyers to buy consistently at that level that's just below the FBI telephone call level, where you are considered a regular and consistent big buyer, but not someone who's disruptive to the market and therefore an economic terrorist to their fiat Ponzi scheme. Okay,
I will share one more record before I forget. In the first time in 10 years, last time I bought silver was 2015. I bought a batch, few hundred, maybe a couple of thousand, maybe 1,000 ounces at around $17, 2013. I started buying gold again. And just last month I bought 30 ounces, $60,000, which amounts to that many, 30 coins. The reason is this, prices. If you look at what happened to nickel, I highly recommend, guys. The LME, nickel doesn't trade on COMEX, it trades on LME. Or it doesn't trade on CME, it trades on LME.
Yeah.
And nickel went from $10 to $50 in March, within a week, just a year ago. We have a nickel project in Manitoba, that's why I watch nickel very closely. We're also very bull market on nickel. LME is under a multi-billion-dollar lawsuit right now because they cancel, Francis, hear me out. They cancel billions of dollars of trades at nickel over $50. They reset the trades to 30, which is the prior day closing. Nickel went about 350 in like 2 hours. And they cancel the trades. They settle the trades at 30, not 50, at 30. Okay. And then they square everybody at 30 and they call it a day. And why? Because the LME is owned by Hong Kong Stock Exchange, which is controlled by the Chinese government. And the biggest guy short is the Chinese tycoon with ties to the Chinese government. And so you replace the Chinese with JP Morgan. And then you basically replace nickel by silver. And Francis, there you have it. It's silver.
And they had the narrative of bags of stones that they thought was inventory. Weren't the bags of rocks story?
There's now people are discovering how tight the nickel market is. So I think the takeaway here, Francis, is that silver could stage identical replay. Like you don't know how tight it is until until it breaks out. And that magic marker is 30, Francis. So once silver goes to 30, can it go to 50 in like 2 days? Entirely possible. When things get out of hand, it's just going to go completely out of hand. And there's no recourse or there's no remedy. And the government's remedy would be they're going to hold CME, they're going to hold the futures market, they're going to hold the trading of SHE on the ETF. They're going to reset the market at 30. And unfortunately, Francis, they're going to redeem your contract, your ETF at $30 an ounce. And then they're going to hold the market like LME. They hold this nickel trading for a week. And then they had all sorts of crazy things happen. Francis, hear me out. What they did is they allow certain players to roll their futures contract without settle. Okay, which is crazy. And then you cannot short, you cannot long. There's all slew of new rules that come. Literally the nickel market, the LME nickel is done. The volume went down 90% from pre-halt levels. And then you can gap up. If there's a limit, there's down limit, up limit, there's margin, and the margin is up to 70%. There's all sorts of stuff going on. So my point is, Francis, you need to get physical. The takeaway is you cannot buy synthetic. You have to buy physical, because the day will come when they hold the CFE, and they will cheat. They will give you $30 on 50, and you will short pocket at 20, and there's absolutely nothing you can do. You're gonna see the silver market rip, and there's nothing you can do. And even when the CME resume trading, it could print $40, but the physical is gonna trade at 70. There's gonna be a disconnect, and so that's why I advocate you gotta get the physical now. These times are different from the past. This paper trading thing is gonna blow up, and that nickel trading is shocking of the in terms of the measures that they took to suppress the nickel market. It's astounding.
And just out of interest, corporations that need nickel are probably now doing bilateral direct trade agreements with mines because that volume's gone on the exchange. It's almost as if the exchange is no longer deemed a viable source for purchases. How are people getting nickel supply now if the volume has fallen 90%, because this is proven to be a scam?
For instance, it shocks me. It really shocks me on how oblivious and how almost obtuse the industries are. And let me explain that to you. You see that's so obvious, right? Writing on the wall. However, only Elon Musk is doing exactly what you're saying. Elon Musk is going to Vale, which is one of the largest nickel producer in the world. And then also went to Indonesia government, which is the largest nickel source in the world today, going directly after nickel supply. Unfortunately, right now the nickel market is sort of roughly balanced. It hasn't really tilted the balance in like the silver market, even though the writing is on the wall. Because even though EVs are selling like crazy, but EV demand is going to continue to accelerate in the future, just like silver physical demand is going to accelerate in the future. Very naively, for instance, unfortunately, I talked to over 7 major auto manufacturers in the world. They're the top 10, okay? They're so oblivious of what's happening, and with
or are they just co-opted into the same cartel? You will support our exchange. You will not go out of the circle we've drawn for you.
Exactly. You know what they're doing in response, and this is coming from Ford or from GM. So I am not giving when interviewed as to whether they have enough nickel for their future vision of EV, which is going to quintuple, whatever it is. They say no problem. We've been assured by our battery suppliers that there's not going to be a problem. And if you ask the battery suppliers, oh, we have been assured by the Glencores and by the Trafiguras that there will be ample supply. I mean, and then the Trafigura and Glencore, what's happening now? They're discovering their feet has got bags of sands, and then it's hundreds of $1 million, it's $700 million fraud. Trafigura nickel, they've been defrauded upwards of $700 million. So I think everybody is still putting a pillow under the base. They're not seeing anything inevitable that's happened. And I'm quite shocked that given what's happened in 2022 with what happened to the nickel LME, that they're still not woken up yet. They're still like, very nonchalant about what's.
But I get the impression that the CEOs of Toyota, Ford, etc., that are at the Bilderberg Group will be saying, "Don't you worry your little head about that their problem. We have that sorted." And of course the Glencores, which is very deeply into the cartel, as you'll know, with all the stories, etc., they'll be saying, yes, don't you worry, supply side, leave that to us. but we could in fact be in loggerheads where it's not about chips for cars. It'll soon be about base metals that won't even be available.
It will not be available. It's going to be a head-on collision. It's no question about that, Francis. And I think let me sort of back roll a bit. Let me retract a bit. I mean, these auto manufacturers, they have a lot of moving parts, right? To put a car in place, you have what? Copper, nickel, and tires, and seat belts and the airbags. So nickel used to be a small element of it, and I just don't think that they haven't paid the attention to the potential head-on collision, the imminent collision. But I think they're catching up quickly, and that's why they're approaching companies like us that has a pre-production stage project that's not going to come on stream with nickel for another 5 years, and yet they're talking to us, which means that they are starting, their lipo is starting to catch on, but they need to go faster, because I mean on the most conservative estimate, by 2030, EV is really going to have a 30-40% penetration. You're going to need double the amount of nickel, and right now the nickel supply is going down. It's not going up. Why? Exactly for what you said, right? ESG, permitting, local oppositions,
Right.
It's all that. There's no new nickel coming out of the ground. So how it's going to balance out? Well, a lot of substitution need to happen, just like silver in the panel. You're going to find more substitute for silver in industrial demand, just like they have to find substitute for nickel in. So the price of your fork and spoon is not going to be looking as pretty as before. It used to be a lot more higher nickel content, and now it's not even as shiny and maybe a little rusty on your utensils. And your piping might have some more chrome than nickel. Might not be ideal, but that's just the way it has to go. Because right now, around 70-80% of nickel goes into stainless steel. So there is a bit of substitution effect that has to happen.
Yeah. So, but that's going to put pressure on other metals that are going to be the substitutes, and they're going to run into the same situation in due course as well, because it's all metals are dug out of the ground at some point. You've got to return back to the same problem. You might buy a little bit of time with substitution. You might get quality drops, but it's going to end up happening. So if you were buying, if you weren't already heavily invested in silver elephant mining, what small caps that are yet to go production but are of great quality, or even one or two that are broken ground and they are actually early doors production, small cap silver miners? So I say to my community, I want to find you a 50x to 100x possibility, a 20 million or a 50 million or 100 million mine that's going to be 2 billion, 5 billion, 6 billion. Which other names are people that you respect, that you think they're onto a good thing, and they're currently still not appreciated?
Yeah, Francis, I want to go back to the nickel, right? Just 1 minute. Just one thought I want to finish.
Sure.
Is, as you and I would agree that the market fundamentals, it's not the fundamentals, industrial demand that drive. It's not the fundamentals that drive the market. It's not for housing market. It's not for silver. It's not for nickel either. It's always the speculators. And that's, so what I'm saying is that even with the strong fundamentals, you think the stocks didn't go. It's going to go places you probably never even imagined, because you have not introduced the speculator element to it. And that's why Sprott Asset Management is creating a ETF for nickel. And I think you're going to have a lot of this physical ETFs going to come out stream, and molybdenum, which is another minor metals. And, that price just doubled. Moly price doubled just in the last 3 months. It's because all of a sudden that more people need moly than ever before? No. Is there some mine disruption? No. Just like oil, right? You were talking about oil. Oil demand is always be 75 to 85 million barrels, but all of a sudden you draw or added that 5 million barrels of demand, that could cost double or half of the oil price. So it's always this spec element that would dictate like I said again, I think it's only getting started. You're getting the smidges of action that could take place, like nickel, and you see moly, and when silver really got into it, my God, right now it's very underpriced. Now talk about silver junior market. I will focus on. I've been around for 25 years, and many people, even industry insiders, call it wrong. I will focus first of all on silver juniors with resources in the ground. I think that is something that you don't need to be speccing out on exploration. And then secondly, you got to diversify a bit on geographics because you never know. Mexico used to be great, and now they have a lot of problems. Bolivia used to be very problematic, and now they're embracing investors with open arms. United States used to be the blueprint like Nevada, and now they're in this crossroads as to whether they want to go green or want to commission mines. Even in Canada, different jurisdictions and provinces, Manitoba is great, British Columbia is problematic. And even within the province, different locations, communities have different views on mining. Now, my pick is Silver Elephant. I don't think dollar for dollar you can find a better deal. And we have been purposely sort of throttled in our marketing promotion. That's why it's not anything wrong with the mine. We're just hunkering down. We're not doing as much promotion. But we're now embarking, but silver is broken now. So I like the Silver Elephant a lot, 20 cents per ounce silver in the ground. You cannot beat that. But there's
fine. For those watching, and so that you can get to plug this properly, I don't mind that at all. And I'm sure people will recognize it's not advice. What is your code on the chart? Sorry, Toronto Exchange.
Yes, on the Toronto main board, the symbol is ELEF. ELEF.
Yeah, okay, that's a good one. Okay, excellent, makes sense. ELF, and it's on Toronto Financial Corp. ELF Financial Corp. EL Financial.
No. Yeah. That's on the Toronto.
ELEF. Yeah, that didn't sound right. ELEF. There we go. Silver and Elephant Mining. Brilliant. Let me just pull that up. Now, people should expect, obviously, a very low liquidity on a smaller cap equity. I see it's been listed since 2007. Is that correct?
Yes.
So let me just bring that up and people can see that. And it's getting unloved for now in an environment where the love should be coming. So quite a bit of volume since 18 to 23, but before that pretty thin. And this is ELEF, Silver Elephant Mining Corp. So market cap is just 20 million at the moment. Is that correct? Did I understand that correctly?
Yeah, market right now is 16 million. And Francis, we were most loved 2 years ago, and now we're the least loved. These things go in pendulums. And I mean, when you talk about liquidity, I think you and I agree when the market is at the bottom, it's the least liquidity. And when the market is at the top, it's the most liquidity. You know, I remember when I was buying a condo in Vancouver, Asian, in year 2000, when nobody wants. So why would you buy a condo in Vancouver? There's no volume. You should buy something in Vegas. And that's year 2000. That's the top of Vegas. It was bottom for Vancouver housing market. In 2020, in 2021, the company was trading turnover every quarter. We were trading the entire flow. I mean, we're trading 3-4 million shares a day. I mean, see the scale on the volume. So liquidity is not so much. If we believe that the bull market is coming for silver, I would not be concerned about so much more liquidity because, for instance, we have the goods, we have the silvers in the ground. So we're not as speculative as some exploration stories that's based on 1 or 2 drill holes, right? We have the silver in the ground. Now, if you want to talk about, the market is trending. The company is well cashed out.
Would you sell to someone else to take to production? Is that an exit strategy you're considering, or is it your intention to go through the whole cycle and start a mine and go through that process? And do you have the skill sets and the people around to do that? So people are going to look for the points of failure, and they're going to see a technical chart that looks, mainly down. I've got it on log scale at the moment, but if, on unlogged, it just looks like, something that's, they will think going to zero inevitably, but it's not. It's just an unloved industry at the moment, and you're an unloved example that's a little bit micro cap. Where's the points of failure? Do you have any known bad news that is an issue or that's going to be more problematic for you that you should disclose at this point? For example, you're going to expecting a higher, cost of extraction because of X, Y, or Z, etc., or anything known?
Right. Well, I think, for instance, our chart is not very different from other junior miners, including First Majestic. The company just acquired the silver project in 2016. So if you look at only for silver, then you got to really look at the price action starting from 2016. The price broke down in 2022. First of all, let me say that there is no undisclosed material events that is sort of adversely affecting the stock. However, in 2022, there is a correction on the company, and part of that was that there was a spin-off. There was a corporate transaction where the non-silver assets were spun out of Silver Elephant, such as the nickel project I talked about. So some people were in Silver Elephant for nickel, so they were buying and Silver Elephant to get the nickel dividend shares. So I think there were some attrition from Silver Elephant base, and that's why the share corrected, because once the nickel guys got their nickel shares and they no longer wanted Silver Elephant. So there's a bit of a correction in that. And unfortunately also that, for instance, we caught in that down shaft, right? So like 2022 was not friendly to the silver market. So I think it's a combination, the corporate event coupled with the driven down of the silver market, that sort of precipitated to what you see. However, you can also see that the price has bottomed since middle 2020, since the middle of 2022. And
did the nickel components get a separate listing, and could people look at that if they were interested in nickel, or was it privately sold off and there's no participation?
No, so if you look at the nickel symbol is Flyn, Flyn. The company's name is Fly Nickel, so Flyn.
Got you. So that was then that should have a 2000 yes, I see the listing also hit quite hard. Let's just go to a retweet.
We came out with a bang at $100 million market cap. We traded 10 million shares in March when we got listed.
There's your volume.
So unfortunately, sometimes, Francis, that people get caught up in the moment. Maybe the story is really got some legs to it, and we exhaust the buying. So at times, for instance, everybody came in, and then they bought what they wanted, and then went through a harsh ride. However, you see 2023, when the metals market bottoms, you can see quite clear that there's a volume in breaking out of that downshaft. So we expect the Fly Nickel to be a very good proxy to the nickel market going forward. This project has 1 billion pounds of nickel in the ground, 85,000 meters drilling, and over $40 million of investment. Very similar theme to what you saw in Silver Elephant. Because, I mean, for instance, in hard...
But again, pre-mining, but proven reserves.
Exactly. So, for instance, I cherry-pick these assets. I'm an investor. I'm a CFA. I'm like you. I'm looking for... I have a forecast on the metal, and I look for an asset that which can get me that leverage, right? If my scenario to play out, which it did, because we bought Silver Elephant bought the nickel mine for $15 million in 2021, and in 2022 nickel went to $50, and we IPO'd at $100 million market cap. Unfortunately, Francis, I am a CEO of a company. I didn't sell a single share. In fact, I doubled my holding at 60 cents. Never even imagined it would go to 10 or 13. And so I'm not as nimble as you are, Francis, in my risk control. I don't know
if I would have done much different. I think people are going to feel more encouraged to hear that you are still skin in the game, and in fact added to your skin in the game, rather than just were exit strategizing on the IPO. I've had enough of investor banks that do super flaky, super high valuations and sell on the hype and are actually greatly reduced in the subsequent slump. So I think you're winning on the integrity stakes if you're not winning on the financial stakes just yet. And the long game is the long game.
Well, Francis, I think just on nickel in terms of leverage, right now nickel valuation is very similar to silver at around $16 million market cap. At 1 billion pounds of nickel in the ground, you are paying 16 cents per pound of nickel, and nickel right now is trading at $10. So that is the optionality that you're talking about. You're paying 16 cents for a pound of nickel that's trading at $10. However, nickel is $10 a pound, it's not $30 an ounce, it's going to cost you more money to get it out of the ground. So that is an optionality aspect. Now, first, I do want to address on the exit strategy. I have been around for 13 years, and I've got, during my lifetime, I've known quite a bit of industry insiders. We're essentially a world-class management team. So we have specialists that understand environmental and permitting, 30-year veteran, and that actually represented governments and First Nations in permitting matters. And we also have a chief operating officer that is a lifelong miner with Valley Inco, 30-year mining, started with a foreman, running a mine, become a general manager. So we are recruiting the pieces together that if the market is conducive for debt equity financing to build a mine, then we keep the option open. More important to the question, Francis, is about the timing of exit. I think that's actually more important as a trader like you are. So I think often CEOs make a mistake. Is, somebody paid 30% premium for my mine, so I have to fulfill my fiduciary duty and sell, right? But you should be looking at not 30% premium to your share price, but you should be looking at the underlying metal, whether that metal is 20% on the bottom or has 20% on the top. I think that is a lot more important that the investor understand that the CEO understands the macro view of the metal underlying that metal. So from where I stand, and it could and my view could differ, but we're not looking to sort of exit nickel or divest our asset probably until nickel is $30 to $40, which is 3 to 4 times from where we are. And for silver, we're gonna make a look at a run at the silver, and depending on interest rate, where the dollar is, or if the dollar still exists. But I would say at the very minimum, if gold at 3,000, like you said, there's no reason not for silver to be at 50. So I don't see any corporate event until silver is at least $50. And then at that time, we prepared our data room. We're going to invite all the strategics and the banks and looking at all the options. And we're making sure that project is fully de-risked at that point so that the project can be shovel ready, that there are no impediments towards production at that time.
Yeah. So get it oven ready, as you say, in the meantime. John Lee, silver, Elephant Mining, and of course also in the nickel business. We've just taken a look. It's been an absolute pleasure. We've spoken for a long time. We might have to split this into 2 parts. If people want to find your website or to know more about you or contact you, where do they do that?
Yeah, so the company's website is silverelef.com. If you just Google silver elephant mining, or if you're interested in nickel, which is the metals of the future, then that will be flynickel.com, FLY nickel.com.
Gun to your head, the bigger turn in percentage valuation, silver or nickel? And I'm taking one of your mines away from you. You gotta keep just one. Which is the hold?
I got about $1 million on both, on each. My equity holding is almost identical for each one of them, for both. They're both my babies, a Sophia's choice. If I have to venture and say, in the short term, I like silver more in the next 6 to 12 months. But I think that both are, they do have dynamics are different. Like, for example, silver, you're dealing with the cartels, you're dealing with the fundamentals of the money. Nickel doesn't have that problem with somebody who's managing the nickel market. But nickel has a different set of dynamics in terms of laterite production. There's a lot of resources in Indonesia, but it's a very dirty process. And then also the market could find a substitute for nickel given how quickly technology is advancing. So every market has a different pros and cons. I see both market at least double from where we are. Metals, like nickel easily 20 to 30. Silver, I think the long side nickel might have a better upside in silver, but silver has a bit more torque in the very near term because of the geopolitics that we're seeing, the central bank diversification. So I think silver can easily go 30 to 50, but nickel probably $15 to $20 for this year. Right now, nickel is at around 10. I think 15 is probably more realistic for nickel this year. But silver, 50 is a very distinct possibility.
Awesome. Thank you so much for coming on and sharing your wisdoms. It's been really enjoyable. And we must do a check-in again in a year's time or even 6 months if you've got anything new to tell us.
Francis, it's such a pleasure. I wish I had known you earlier. I definitely check out your YouTubes. You have 3 years of And I see you have a lot of good track records, and I'm certainly, I'll be very interested in studying your thoughts further as well.
Yeah, that's great. That's very kind. We've had Rick Rule on, for example, who's someone I'm sure you'll know who was big on the uranium. We've had some interesting guests. We're looking for more, much like your good self. Have a great day, and thank you very much, John Lee. Have a great day. Thank you.